In this video, we will discuss duration calculations using as an example a problem similar to one out of the Hall Options, Futures, and Derivatives text. A 2-year bond with a yield of 5% continuously compounded pays a 4.25% coupon twice a year. This is an example bond, or more specifically a note, from the treasurydirect.gov site. So we have a 2-year note. Again, bills are government debt instruments with a maturity of less than a year. Notes are government debt instruments with a maturity of 1 to 10 years, and bonds are 10 years to 30 years. So here we have a 2-year note with an interest rate of 4.25%, and now interest rates demanded in the market have gone up to 5%, so we will expect this note, our bond, to trade at a discount. We will ask the following questions, our assignments related to the note, our bond. A, what is the bond's price? B, what is the bond's duration? C, use the duration to calculate the effect on the bond's price of a 1% increase in the bond's yield. And D, recalculate the bond's price on the basis of a 6% per annum yield and verify that the result is in agreement with C. So D, we do an exact calculation of the bond's price. C, we use the duration approximation. And for small changes in interest rates, these should be very similar, and we will compare the two. So let's start with part A. The price of a bond is just the discounted sum of all of the cash flows of the bond. So the coupon payments multiplied by exponent of minus the interest rate to the number of years of when the cash flow takes place. So what are the coupon payments? We have a 4.25% coupon bond. It's assumed to have a face value of 100, so we take 0.0425 times 100 and divide it by 2, and we get $2 or $2.125. Since this is a 2-year bond with semi-annual payments, we will get the first payment of $2.125 in 6 months, and the present value of that will be $2.125 exponent our interest rate of 5% times 0.5. So we get 2.07. The next payment, the only change, is our time right here changes to 1. So we get 2.125 exponent minus 0.05 times 1, which is $2.02. And then we change that interest rate to 1.5, and the present value is then $1.97. And then at the maturity of the bond, we get the $100 face value plus the coupon of $2.125, present value thereof, which means we take all of that to minus 0.05 times 2. Now we have the present value of all the payments. We sum them up, and we get the price of the bond is $98.47. And again, the bond is trading at a discount since the yield in the market of 5% is above the coupon payment of 4.25%. And the remaining 0.75% is made up by capital gain as the bond's price increases from now until maturity from 98.47 to 100. So that is our answer to part A. Part B, what is the bond's duration? Well, the duration calculation is similar to the calculation for the bond's price. The difference being right here is the summation of the present value of each coupon discounted to the time when it takes place. And then we now take the present value of each coupon, we multiply by the time which it takes place, and then we divide by the price of the bond. So this is in dollars, this is in dollars, this is in years. The duration will be in years. So first we will sum all of these terms right here. Then at the end, we will divide by the bond's price. Our first term then is going to be the time T1 when the first coupon is paid, our 0.5 years, times the present value of that coupon, which is $2.07. So 0.5 times 2.07 gives us $1.04 years. The next term is going to be 1 times the present value of the coupon. So it's going to be 1 year times $2.02. That gives us $2.02 years. The next term will be 1.5 years times 1.97, and that will give us $2.96 years. And then our final term will be 2 years times $92.41, or $1.8481 years. Now we sum all of these terms, and then we divide by the price of the bond. And we end up with a duration of 1.94 approximately years. So the maturity of this bond is 2 years. Duration is a measurement of how quickly you get your money back. We get our money back in slightly less than 2 years because we have coupon payments. So at least on an average basis, we got our money back in 1.94 years. And that is the answer to part B. Now C asks us, use the duration to calculate the effect on the bond's price of a 1% increase in the bond's yield. Well, if the yield goes from 5 up to 6, interest rates go up, bond prices go down, so the bond will have to drop in price somewhere below the 98.47. Duration is a Taylor series analysis, and it is the linear term, delta y. Using that Taylor series analysis, you would say the change in the bond's price is going to equal minus the current bond's price times the duration times the change in interest rates. On a percentage-wide basis, delta B over B is then going to be minus the duration times the change in interest rates, which is minus F23, our duration here, times our change in interest rates, which is going to be 0.06 minus 0.05. So it's basically just 0.01 times this minus 0.0194. If we multiply that by the bond's price, which is the 98.47, then we get a change in the bond's price of negative 1.91. It should be negative since interest rates have gone up and the bond's price is going to drop. Okay. So the final bond's price, B2, is then going to be B1, 98.47 minus $1.91, and that gives us the duration approximation for the bond's price is $96.56. Now there is another term in the Taylor series called the convexity, and we will study that in a later video. If interest rates change by too much, then we will have to use that term, the convexity, to figure out how much the bond changes in price. So this is our duration approximation. Part D asks us to exactly recalculate the bond's price based on a 6% per annum yield, and then see if it is in agreement with our answer from C, the duration calculation approximation. So now we redo our calculation in A. The only difference is now our interest rate is not 5%, but 6%. So we start here again and figure out the discounted value of all of our coupons. The first coupon is, again, $2.125. We discount it at 0.5 times the interest rate of 0.06, and we get the present value of it is $2.06, slightly less than here because it's a higher interest rate. The second coupon is discounted at a year, so we get 2.125 exponent of minus 0.06 times 1 gives us $2, again slightly less than this because we're discounting at a slightly higher interest rate. Next term, 2.125 exponent minus 0.06 times 1.5 gives us $1.94, again slightly less than the $1.97 from Part A. And our final term, again, we have 100 plus 2.125 discounted exponent minus 0.06 times 2 gives us $90.58, less than this term because interest rates have gone up. Now we sum all of these terms and we get our bonds price, our final bonds price after interest rates have gone up to 6% of $96.58. So our duration calculation approximation here is 2 cents less than the exact result, and the difference between those two is due to the convexity term. I thank you for watching this video.